Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Welcome to another episode of the Property Nerds podcast. I'm your co-host Arjun Paliwal, and we've got something different cooking on today's show. I've asked the gurus and the experts to come in and join me on the commercial space, and so we've got our head of commercial, Chris, here. Chris, how are you, mate?
I'm good, thank you, my man. How are you?
Yeah, good. And we've got Jack from Fouracre Financial, who is a commercial gun as well. Him and his team have been doing some great things working with our team on commercial finance. So can't wait to jump into today's episode because this has been a hot demand, highly requested episode to talk about commercial finance because resi, I think there's enough transactions that go on in Australia, close to 600,000 a year almost, where people feel like that's kind of well understood, even though you were surprised that, Jack, there was a lot of conversations. He goes, it's not as well as understood as we think. There's a lot still to teach people, which we do on the Property Nerds. But today we're going to go into commercial financing and just talk about the world of commercial finance and property deals in 2025, how to finance them, things to consider. So Jack, I might come back over to you, mate. Firstly, let's talk about just the financial landscape, meaning like, how's the lending environment changing right now in the commercial? What are you kind of seeing things come up so far?
Yeah, so I'd say that a lot of lenders are coming into the space, like a lot of the third-tier lenders and even some well-known names in the lending space are coming into commercial. Not a lot of them drop out once they go in. They're also increasing their loan amounts and LVRs to try and attract more business and, longer loan terms than we've seen previously. So, yeah.
I think the main thing to read from that is like banks are taking it seriously now because when you're at a high interest rate cycle, and you see the chances that coming down, banks are trying to get on the front foot to capitalize on that because they've already seen the first movement down. And as interest rates are where they are now, and as they keep coming down, the net returns just get smoother. But also you de-risk the dealing for the bank from a risk perspective because they're like, hey, assets are so self-servicing as the next few years rates come down that all of a sudden we don't see the default risk being as high. And they're able to cover that a lot more. So obviously there's industries and which industries are good and not good. But talk to me on the LVRs part, Jack, just in terms of what you're seeing out there, because usually we've seen commercial be this huge cash hungry machine that you need to input 30 to 50% deposits on some specialized assets. What are you seeing out there now across the world of LVRs?
Yeah, well, it's no secret that one lender that was doing 100% LVRs. It wasn't that simple though. You had to be a business owner, and 30% of the 100% LVR was done on a much shorter loan term, so serviceability was quite difficult. But plenty of lenders are doing 80% LVR for commercial, and even more so in the SMSF space. We'll touch on that a bit later. But it's quite common. You'll see 80%, 75, 70% LVRs with commercial.
Awesome. So now what we means we're talking on a 2 mil purchase price. Chris, if I got my numbers right, sort of 20% on a 2 mil, 400K.
That's right.
Cost for purchasing maybe another 150K. So you're up 550 is that minimum cash input.
That's right.
And if you're getting there from cash, that helps. If you're getting there from equity, that helps too. But just be mindful that on the equity front, it does mean you're 105% lended. And that means that the cash flow is not going to be as good. So you have to just make sure that that's the vehicle for you or not. And that comes through strategy. But mate, coming to you, Chris, from your side, obviously you're seeing different movements in the finance world. And as a result of that, what are you seeing versus banks versus non-banks, right? You're seeing a lot of different type of lenders come up. Are you seeing anything from your work with Jack that's like, hey, interesting to see these new players into the mix?
Yeah, so I think Bank of Queensland, Judo Bank are coming into play at the moment, which we never saw in the past. 70% LVR for lease stock loans. I've never seen that before.
And they're sharp interest rates. I was surprised when I saw some of the deals you guys were looking at, like, with sixes in front of them, lease stock.
Crazy.
Yeah.
It's unreal.
BOQ made a really big shift in they're not really focusing too much on the broker channel for the resi side, but they made a really big shift to commercial.
This is where, the whole bank versus broker thing comes back again, where you got to know your options, know that constantly evolving world. Now, in terms of banks, like we now know what's shifting in 2025 as a landscape. So it's like LVRs are shifting, more are opening up, lease stocks are coming into the mix. Talk about what matters now, Chris, in terms of, just the like the net lease income, the tenant quality, the importance of that in this environment when you're seeing finance shifts the way where they are?
Yeah, so what I'm seeing at the moment is the higher the net yield, obviously, the more funding you can get, especially with lease stock loans. But also tenant covenant, like the strength of the lease, like the Mercedes-Benz deal that we presented before. Yeah. Tenant strength plays a big part, and the history of where that tenant has occupied the premises as well. So if they've leased it for the last 20 years, they're likely going to lease it for the next 10 years, right? So that adds to the finance play as well.
Now, I know in terms of that finance play, we've seen where we've all collaborated, and packaging of deals is something that's quite important, right? Could you talk about what that means when someone's like wondering a packaging of a deal, Chris? Because I think when you think of resi, it's like, yay, here's my contract to sell. Over to you. Don't ask me for stuff. I gave you docs before. I don't want to talk about it, Jack. But in commercial, it's different, and it can be the game changer in getting assets forward, right? Getting deals to be made on time, even with such strong assets. What is deal packaging? What's the importance of it? How does it work?
Yeah, so when we package a deal up in commercial, we get all the property details, the asset type, the location, the net return. We package up things like the lease as well. And we do a cash flow model for the banker as well, just so they can see what things look like. They can take the numbers out of that cash flow and they can put it into their own models and package it up for the bank. So it's in one nice little, you've got the details of the property, the broker will add the details of the client, and then they have all the information like the lease, the contract of sale, everything like that.
Yeah. I can't tell you how valuable that is for us. Yes, like that email, it's as simple as sending it to a bank and saying, hey, check this out. And from there, they're back to us within an hour. Like they look at that, all the details are there. And you could see the difference when you get a client that does something as stupid as buying a commercial property without a buyer's agent. And they come to you and go, I got this property, mate, here's the link. And they're just kind of, you got to take their word for it. But then you've got to draft up the email. It's a lot less detailed than what you get from Chris. But it's really helpful to shop the different lenders for the type of property we're looking at.
Yeah, absolutely, guys. And funnily enough, people don't recognize that 14 to 21 days, whilst it might seem like a long period, it goes fast, right?
Yeah, it's about how long they take to do a valuation these days in commercial, mate.
And that's the thing, right? So this is something new to resi investors. Resi investors, what you need to realize is that your valuations can be done at a system. The algorithms are built in that way. The desktop level, which simply means that an assessor was looking at it at a manual view, but just on internet examples of comparable sales. Or a short form. Short form, they go out to the property, they look at it. But again, inspections can be arranged in 48 hours, fast turnarounds, and 24-hour reports back. So all of a sudden you're talking, 48 to 72 hours and you've got reports back. Commercial, whole new world. They're investigating the lease. They're doing what they call a long form valuation. And some turnaround times can be quick at 5 business days, but quick is not 5 business days, right? Because if you think about it, plus a weekend, it's 7. That's a whole week gone of your clause.
Plus the 3 days to get the quotes.
Absolutely.
You just got to get the quotes and then they're going to do the bloody vow.
100%, right? So now you've got three days to get quotes, because remember, you might go one valuation at 5,000, one valuation at 1,500, one valuation at 2,800. But remember, it's not just the cost. Chris has dealt with so many valuers, he can see that don't go to this one, because when we use this one, we see different valuations come up. They're really either passive or too bullish in some cases. The main thing here is you need every single day in commercial to get it right. You can't kind of let it slip. And so I think that deal packaging part you mentioned is really important. Jack, are there any the deal packaging mistakes that you see when customers come up? Obviously dropping a link is one, but do you see hey, there's missing docs that you get and you have to rework it? Or do you see certain responsiveness issues? I think the main thing is what can kill the deal at finance time for customers that doesn't go as smooth as you want it to?
A pretty common one is when a client would overstate the rental income and then not give you the net rent figure, whereas Chris will just tell you that straight up. Whereas the client, they're just taking the word of the sales agent and just using that information. But if they dig a bit deeper, that's not the net rent, and that could throw out servicing a bit. But that's a pretty common one.
Yeah.
So they're just not reading the lease, essentially.
Yeah.
Seeing the exclusions and the inclusions of the net lease.
Yeah. You can't expect them to know how to do it if it's their first time, especially. But I just can't recommend enough using a buyer's agent for commercial, man.
Yeah, 100%. Now, Chris, I want to come to you for this one. Whilst Jack's talked about a few LVRs in a general sense, there's LVRs that are different from asset types, right? And this is a mistake we see people make often. They see a great deal. Let's take a childcare or a car wash. And they're like, these numbers are ridiculous. I've got the money for it. I'm good for it. But then they realize the math ain't mathin', and the money that they thought they were good for wasn't what they were good for, even though on normal residential lending LVRs at work. Could you talk about specialist lending or specialist LVRs just for people that may look at an asset, think that's great, but really don't know the numbers they need for it?
Yeah, of course. So specialized asset means just one use. So a childcare facility can only be used as a childcare facility. If it becomes vacant, you can only get a childcare operator leasing that place, and that could take up to 6 to 9 to 12 months. So your downtime is the risk here, and that's why banks will only lend. Typically, the maximum I've seen for a childcare facility is 65%. That's pretty good, I would say. But most would probably just give you 50.
Yeah, wow.
Yeah,
So
but
65.
65, but you've really got to compromise on the rate if you go on 65. If they're the only one offering 65, it's for a reason. They're going to charge you for it. So if you want to get prime lending, you're up around the 50, 55. It makes sense that it's specialized lending, but like, I mean, I got kids. I remember trying to get them into a childcare, and it's like there's not enough of them around. So I don't think
demand's wild,
mate. Honestly, like I don't know, especially for something like that. It's not like you would see the industry change in a significant way where that wouldn't be a viable asset long term. Like I could understand from office spaces or something like that, but it seems like they're more friendly to office spaces with everything that we've seen in the last few years with work from home. But 100%. A childcare center at 50% LVR, you're kidding.
100%. And I think that's a big thing that needs to change. And the reason why is that like, you got to look at Australia now as a whole economy. I know we're going a little bit to this like childcare specialization conversation, but I think I've got to, you know, have you seen that Family Guy episode? This grinds my gears, and he just like goes, yeah, I feel like this grinds my gears, right? And what this is that you have a declining birth rate. So you've gone from a 2.6 down to a 1.5 birth rate. We
can change that, mate. Me and you combined.
I'm two in.
I'm two in too,
I'm above the averages now. I'm above average. And so I think from that perspective, what I find is like, you know, migration's a big topic, right? And migration needs to happen in Australia massively for certain labor, skilled and everything to come in. Because if it doesn't, relying on a 1.5 birth rate, you're looking at Japan 2.0. You know what I mean? And we have that, what do you call it? The silver tsunami of the next 10, 20 years to come up. I think the main thing you got to look at is that childcares, if you're going to start from the funding cycle and you improve that, you improve the construction availability for that, you improve the red tape around that, more of them pop up, supply will increase, costs will reduce too, because you can't keep charging the same if you're not getting the same amount of kids, and you want to be able to increase the demand in your center. And then as costs improve, parents and their affordability of having a kid is another big reason as to why they don't have kids.
Yeah, 100%.
You know what I mean?
Yeah.
People now, back in the days, had one person on an income. Now it's like you have kids and two people aren't working. Like that's a luxury. That like what I think now we have at home, where I'm the sole income earner, is like this, you know, no pun intended, Taj Mahal type luxury thing happening. Like it's like royal family of India. Like what? That my dad's days, that was like every household was one worker, one looking after it. But now it's like this like huge luxury that you've worked like your butt off to reach. And so it's crazy because I think if childcare as a funding, I know we're talking commercial finance, but this has everything to do with that. If we can fund more, if there's more availability of it, whether it's construction of new or whether it's established, changing hands and staying active, it's going to help a lot. But I mean, that's just a side note, I guess, just on that. And that's importance of specialist lending. Because now, Chris, if we're talking, just love to do some math here. Someone looks at that at a commercial deal at 5 mil and goes, oh, that's a 5 mil industrial. Jack can get them away with a 1.25 mil cash input, right?
That's right.
But then suddenly, if we're talking at a 65% LVR, now you're talking 40% deposits because 5% for costs and 30 for that, 2 mil cash input. So your math has gone from going, I need 1.25 to 2 mil, which look, many people have in the childcare industry when they're buying those assets. But if you're unaware of specialized lending, you just completely change the game. You like need an extra 750, and it's, you know, I don't know how thick people's mattresses are with an extra 750 cash. But that's a big part. So look, that specialized lending is one part. I guess the next thing I want to talk about on the lending parts is just this world of alternate lending. Right, we know there's lending for commercial to buy a commercial property, say in a trust or personally. But there are now more and more vehicles open up where people buy commercial property in. One thing being SMSFs. Could we talk about the rise of commercial lending you're seeing, Jack, and SMSFs, and why people consider it as part of their strategy to begin with?
Yeah, so again, more and more lenders are jumping into SMSF because they see it as a massive market to be lending in. So it's very common to see 80% LVR on a commercial property in SMSF, but you're also seeing 30-year loan terms across the board, which you can probably see that once or twice, maybe 3 times outside of SMSF. But in SMSF, I mean, I struggle to find a lender who doesn't do 30 years at 80%. And, there seems like there's more lender options that are playing in that SMSF space than in the commercial space outside of that. So I don't know what's going on, but like even a residential property in SMSF is still considered a commercial deal. But I don't know why they would treat a commercial property in SMSF so much more favorably than outside of that.
It's interesting, right? Because they're doing it even though there's less options of them available. You'd think in a world with less lenders, it's less favorable, but they're making it more favorable. When you have more lenders, it drives competition
up. A lot of lenders, man. A lot of
coming
lenders
up in SMSF
in
now.
SMSF, because I do SMSF only now. Like we've got a team of brokers, we got commercial only. I do SMSF only. So I know how many lenders there are. There's only a few that we deal with, mostly that have the offset accounts, but all the third-tier lenders that are popping up wanting to get into that space is, I don't know, I might be missing something, but yeah.
Yeah, no, it's big. It's big. I think they're seeing the rise of it because we actually did a study on it on the SMSF space, and there was a research that we conducted with the survey research to understand what's happening, and a combination of low trust in like the government or funds looking after your future.
Yeah.
Secondly, a combination of like wanting more control, like people just wanting to control their own funds more. And then third is the final piece of the boom that has occurred in property over the last 5 years has given people a confidence of, I want exposure to that, right? But on that note, in terms of people thinking of the SMSF, firstly, get financial advice to make sure it's the right vehicle for you. But secondly, if you're looking at commercial, yes, whilst the LVRs are good, we also want a certain price range to hit. We often find a fund in SMSF with 550K or more in cash position combined with, say, a husband-wife as an example, would be a sufficient balance. Because in the 400s is usable for the actual purchase of a commercial. And then you've got some buffer in there for offsets, rainy day, potential diversification. So you want to be in that 550, 600 plus when it comes to an SMSF balance together to purchase a solid commercial. Chris, I want to come to you to the last one here. And where I want to come to you with is more so for like people's lending considerations. You've seen, collaboration with Jack and collaboration understanding the finance, and you've seen people, obviously the packaging deal was a big one. Different structures was another one. So Chris, this has obviously been a good segment covering into finance and just looking at it from, LVRs, commercial finance, differences, specialized assets. But I want to come to you for anything non-finance you see as an impactor to deals going through smoothly or not in commercial and what buyers should be ready for, whether it be the greater team or whether it be, to do with finance. What are some final thoughts you have there?
Yeah, I think it's mainly around communication is the big one between, especially getting the buyer to introduce the broker to, your buyer's agent. There's a bit of fluidity there where the broker and the buyer's agent can work on the deal together. Or if the buyer is a sophisticated investor and they don't have a buyer's agent, just making sure that they're communicating with their broker, getting what they need to the broker. Broker sends them the list, checklist. Also just around timeframes, around valuations, getting clear on that, because it normally takes, like we said, 21 business days, 10 business days to get a valuation done. Just making sure that we have that in place and the right settlement timeframes.
Yeah, I think that settlement timeframe is a big one. People are so used to Jack on that resi side.
Oh, digital loan docs all day. But like commercial, especially when it's in a trust, a bit different. You need
guarantor docs, legal advice.
Takes a bit of time.
So you're talking what, typical resi, we've seen 25 up to 42 days.
Mate, I done a 5-day settlement. That was quick. But
they weren't doing you any favors.
But I think, commercial, if you had your act together, you could get it done pretty quick. But once you it's pretty overwhelming once you get that big stack of loan documents, and you just got to get ahead of it. Like, because even if you send it back and there's something that you need changing, they can do that when they're at the bank, like you just send them an email and confirm this, blah, blah, blah. Like you can sort it out. You just need to get ahead of it, get those loan docs back as soon as possible, and just don't delay it.
Absolutely. Now, see, we talk 30 to 42 standards in resi. For commercial, we're talking 60 to 90 standard, right? So I think like, yes, we can get faster, but it's about what's understanding standard, 60 to 90. So don't let the 60 to 90 days creep up on you. It's key, key to work fast to it in those first 21 days, and then the documentation parts. And I think that's a wrap for really getting that commercial financing right. So that's it for today's episode, everyone. So, commercial financing, the landscape in 2025, LVRs, vehicles to finance it, deal packaging, mistakes. These are some of the things we talked about today, and we'll look forward to doing more episodes like this where we'll have a few more of us together in the same room and talk about commercial, because it's been a really booming sector when it comes to inquiries here at InvestorKit. We're noticing a big stage where customers now, because of the life cycle, right? We're 7 years as a business now, and the life cycle is that if we're helping so many people build residential portfolios to a certain level, it's at that stage now where they want to go, I'm ready for income. I'm ready for consolidation. I'm ready to switch that move. And this is now where we're seeing commercial come up. So we're here to equip you all with the best commercial insights we can give you from finance, strategy, and just asset as well. If you haven't already, check out the last episode we did, because in the last episode, we talked about 2 deals that we'd purchased, live deals for clients that went through really well. And you can see some of the things that we make happen. And if you'd like to learn more about commercial investing with InvestorKit, it's investorkit.com.au, and request a free consultation. And from a position plus perspective, usually around that sort of 550K cash and upwards, or equity accessible upwards, seems to be the sweet spot of where we can help with the commercial investment in the mix of things, whether it's in your SMSF or family trusts or personal, depending on your accounting advice that you get. So that's it from us.
Game over.